G'day, my name is Michael Baragwanath. I'm the Managing Director here at Clime, and myself and John Abernethy, our Chair, just thought we'd record a quick chit chat. It's really just our own thoughts and views on things happening in the US and around Australia and the world at the moment. All the normal disclaimers around no advice and just recording a chat. But we just thought, we're managing a lot of people's money. We want to make sure there's a bit of an insight into what we're thinking and the sort of things we're talking about. So that's the intro out of the way. So, John, I was born in 1981, but you got into the markets in 1983. Obviously, there's a lot of stuff happening at the moment. But before we go into what's happening today, can you give us a bit of a background on what you've typically seen when markets get unnerved or are restless?
Well, I think the history of market corrections is usually preempts a recession. It usually is around interest rate moves or credit tightening, inflation leading to credit tightening, leading to a recession. And markets are predictive. They don't wait to a recession. They always preempt a recession. And usually the trigger is an event. Something happens. Not always a black swan event. In the distant past, it's when economies rolled forward with excessive leverage, and the central bank had to check the growth, which was unfundable, put up interest rates, and we had a correction, and those businesses which were highly geared with poor quality cash flow got hit hard, and the banks that lent to them got hit hard. So that's been the history. When you fast forward 2000, market corrections was from overvaluation. Then we had the GFC event, which was a financial calamity. Then we had COVID, which was a disease. And now we've got something which again looks man-made, but it's worth exploring where it fits into those previous historical categories. And maybe it has a bit of all of them when you think about it.
Yeah. And so we've been talking about internally the fact that a lot of these bigger Australian companies are a bit overvalued. And I know certainly Warren Buffett's been saying that the US market's been overvalued. And, he moved significantly to cash over the last sort of 12 months. Do you think he saw it coming, or what do you think the approach has been to those that have been shifting to cash before this occurred? What do you think the driving motivation's been?
Well, Buffett's a true value investor. Because he's got a closed-end fund, and because he doesn't pay dividends, and because he has the respect of his shareholders, he can invest on a different drumbeat. And it's very much his drumbeat. I think rather than raising cash, and I no doubt he did sell some securities, and he did sell down on Apple, no doubt about it. I think he saw overvaluation appearing in the market, and concurrent with that, he saw, in the main, he could get 5% passive investing. So do I buy an overvalued market and maybe chase double-digit returns, which may be given back fairly quickly, or do I sit on a risk-adjusted basis and generate a 5% return? I think he chose the 5% return and said, well, that's what I'm going to do. And it's paid off pretty well. He might have missed a big jump in the market, but he's avoided a big pullback. So he's coming out of that looking quite good.
Yeah. And so you and I have talked a bit about, and this doesn't all just have to be Q&A, you can ask me questions too. But, we discussed the fact that in the Australian market, we've got this massive volume of money just flowing in, right? And it's not necessarily that productive. So my view on this for a little while has been that, stock markets and financial services providers' job is not just to get money for investors and hold on to it. It's to actually go do things in the economy. Like that's our role, right? Is to aggregate capital and then make investments. And when you're shuffling paper amongst the ASX 100, you're not really creating new bridges, driving new infrastructure, making new companies. You're just sort of betting on the future value, right? And I kind of feel like that's what the market's been doing probably across the world, but certainly in Australia, the top 100 companies have just been getting more money thrown to them by our superannuation system. And that hasn't necessarily been turning into new investments in our economy. What are your thoughts on that sort of issue the last couple of years?
There hasn't been a lot of capital raised in the last few years. There hasn't been a lot of IPOs. There's been some companies disappear off the market through takeovers or privatisations. But it's been, in terms of capital raise, one of the slowest capital raising periods I can recall for quite a long time. And that's an issue because when we invest, as you know, we can either put money into companies through a capital raising and hopefully for a good purpose, where the company can turn that capital into a decent rate of return and return it to us in dividends, and we get a revaluation. When that's not occurring and money is flowing into the stock market, it's going in what I call passively. Yes, there is some direction. But I think your introduction question said this, as I understood it, there's a lot of money flowing into superannuation in Australia. I'm on the record saying an excessive amount. I think we've reached the point of diseconomies of scale. By that I mean when you get too much capital to invest, you end up defaulting into indexing. And indexing in the market, the equity market, indexing across other markets, asset markets and country markets. And we've had this big default into America, selling down the Aussie dollar. I've said that over and over again. And it's a worry because when we're not distributing equity into companies who can get a decent rate of return, if that's not what's happening, then you start getting mediocre returns and mediocre returns on capital. Obviously, the best companies can self-fund, so let's not get too negative. And we're seeing a few good companies in Australia self-fund their growth,
but
a lot
of
companies
aren't. Or is it the biggest companies? Because see, I've seen this a lot. So a lot of my time's been sort of property and debt. And what I've seen in the last couple of years, and I've remembered conversations with politicians on this, when interest rates were sitting around 1%, they'd go, oh, it's never been better. You can borrow money. It's great. You expand your business. And I remember saying to those guys, that's great if you're in a very specific set of circumstances the bank agrees with. And if you're not, you're stuffed, right? So what's been created over the last sort of 15 years is this private credit market that's now quite big. And arguably, in my view, having participated in it for a while now, is it only really exists because the banks don't lend, and we've created this two-tier credit system where if you fit in a certain box, you can borrow money from the bank. If you fit in an even bigger box, which is now, even worse with recent changes to what's available with hybrids and things like that, you can access the market for capital. But we effectively don't have a productive bond market in Australia, is my view. And the access to credit is limited to very specific participants. So construction projects, housing projects, elements that, link back to the real economy, those markets are paying 8, 10, 12% interest rates, not 3, 4, 5. And I've seen, just with what you were saying before around, where the largest funds are putting their money in, defaulting to America. I've had this conversation with a few other participants that Australia doesn't really have an effective bond market, that if you want to go, let's say you're Telstra, you're probably going to use Telstra super money, which is invested in US bond exchanges, to then borrow as Telstra from the US. You're actually putting the money out to draw it back in again. Now, not picking on Telstra at all, but that's an example where we've got our own money going through a US exchange to then borrow ourselves, rather than actually having a productive credit market here.
And we're not short of capacity. That's a big issue, Michael. I mean, and I keep on saying this, we're $4 trillion in super and growing rapidly, and we're about to go to 12% contribution rate. We've immigrated 1 million people. A lot of those people are in the workforce. They're contributing to super. So we've got this mass aggregation of funds, capital, a lot of it risk capital, to be deployed. And we're not coming up with the opportunities in Australia to take that capital and employ it in Australia for the infrastructure you talk about, the property, social housing, tourism, education, right across. And it's a real pity because it's a fantastic advantage we have in having so much capital at our disposal, but there's no direction of it. This is what I lament. And I think we're seeing it in the markets today. Here we have a Australian dollar, which has sold down in the last week by 5, 6, 7%. Stock market's back, 10%. So if you're a US citizen investing with US dollars, you've seen a devaluation of the Australian market of around 17% in US dollar terms. It's matching the downturn in America on the same currency. Now, why would Australia match America? We were clearly not as overvalued as parts of the American market going into this this trade issue, yet we have matched it on the downside. And I think the reason is because we're not matching our capital with the opportunity in Australia. Now, is that a reflection of bad management, bad investment thought process, bad solutions being offered to the market, as you say, a bad bond market? I think it's all the above. We have a real problem in directing the capital we've created, with the opportunity in Australia to bounce off the opportunity in Asia.
So what if I'll say something, you tell me if you agree or not. So my view is that investment managers like Clime and others are too small to properly participate in IPOs and other areas, and industry funds are too big and not putting money in Australian market. So I'll put a little bit more information around that, and then I'll say what I think. I look at like Whyalla, right? So here in my state, South Australia, $2 billion was needed to reorientate that plant, make sure we have, sovereign risk covered with steel production, right? Super SA has $38 billion in it. So it would take less than 5% of the state's own super fund to secure steel production, jobs, and all of the connected industry that's associated with that. And yet there was state and federal money that propped that organisation up. So I guess because you've been in the markets for so long, was there a period where you felt that the fund managers were big enough to be able to make decisions around larger scale, either infrastructure projects or commercial opportunities that we're actually just not participating in now?
Well, there's a lot of cycles, and I go back a long way, as you opened up and telling everyone, so that was good.
I might stop doing that.
Yeah, I know, but it's true. But in the old days, and what I call the old days, the 80s, we had some big institutions, and NRMA was one of the big institutions. We weren't the biggest, but we were fairly big and growing rapidly behind AMP and National Mutual, for example. And there's other few big institutions in Australia. And very often, because the investment banks hadn't infiltrated the place, the balance sheets were with the mutuals and the insurance companies, and we underwrote and therefore priced deals. And we sought out good deals. I well remember a case where Woolworths tried to float on the stock market when it came out. I think it was our IEL, which went through the banks. It was and the market knocked it back and tried to reprice it. Remember issues going way back with borrow and rights issues, which were knocked back. So the institution said, no, we're not taking that. And we seemed to have a lot more strength in the market. And then that strength was given up as we demutualised. And then it was given to the investment banks. And when you get intermediaries, you're trying to work out whether the intermediaries are looking after the seller or the buyer. It's he who pays the bigger fee, and it's usually the seller. And they're incentivised to sell assets which probably aren't appropriately priced. And then as we had this growth in industry funds and superannuation, and when you've got a lot of money to invest, and I think that goes to your question about size, very often the more money you've got to invest, your power, the price in the world today is lost. You've got to invest. And you're probably mispricing a lot of deals, and by mispricing, you're taking on a lot more risk than you realise. And I think there's growing evidence that exists in the world today. And indexing as a default is the worst of all possible mechanisms for overpricing assets, where you're just buying an index, and whatever's in the index, and the stocks which are bigger get more money. Not that they or get a higher valuation, which attracts more investment in the secondary market. We've created something which is a little bit out of control, I would suggest at this point in time. And how to fix it, I'm not quite sure. But it seems to me the rectification, and I guess we're going to talk about America shortly, the rectification of all the problems which have built up over the years, everywhere in the world has got problems. And it's because the rectification mechanism has not occurred. I know we haven't had a recession in Australia for a long time. So that's had an issue. The recessions in America, you look at the 2008-9 recession. There was a massive bailout. Now, that didn't occur 20 years before. The central bank and the Treasury would not bail out financial institutions. So that came in. So the lender of last resort, the Fed put. Similarly in Europe. China's been growing with massive administrative support. Japan, in a complete mess, printed money. So we've had decades of imperfections, and we end up where we are today. And I know we're going to talk about it, but the most imperfect situation exists in America today, and that's what's causing the calamity, because the president's come in and said, this can't go on. Yes, you're correct. I have an idea to fix it. And the world's trying to work out, one, is he got the right answer? And maybe, is it fixable? And here we sit today. So I know I drifted in my answer.
No, good. But it raises other conversations because, look, Paul Keating copped it pretty hard for saying this is the recession we had to have, right? But there is an element of creative destruction required to really drive economies forward. Like I look at, what happened with the Asian tigers in the late 90s. And, the countries that, if you like, took their medicine have gone on to become some of the strongest, most productive and healthiest and wealthiest for their citizenry as well, off the back of those changes. Whereas Japan's quite interesting because, it's, as an economy, has effectively just been in zombie mode for nearly 30 years. Since 1987, it really hasn't gone anywhere. And while it's always been able to buy its own debt and, prop up its own market, its ability to innovate has fallen away. And it's now really been overtaken firstly by South Korea and now by mainland China. And with the rise of Indonesia and all these other Southeast countries, I know we're going to talk about Trump now, but I actually think Australia could not be better positioned if we just look for ways to take advantage. If we look at the balance sheet of our country, the debt position we're in, we keep taking debt to buy, I guess, variable expenses rather than looking at fixed ones. So instead of investing in infrastructure and roads and rail and things like that, we're investing in social programs, which are good, but they don't actually give us any more money. So with that context and that pain and potential issues, let's now go to the US. Because my personal view on Trump is, how do I put it? A broken clock is right twice a day, right? So I find I don't necessarily agree with everything, but I think there's reasons why Trump and the people around him are trying to make these changes. And I think we can have a bit of fun discussing that. So I'll hand over to you first. Tell me what you think is happening.
Well, what the viewers don't know is you and I have talked some deep and meaningful discussions. And I think we came at it from different angles, but I think we've ended up pretty much in the same place, which is good. That's how you want to resolve. And I think that's what our investors need to know, that when we discuss issues, we take different perspectives, take on different information, come together, talk about it, and trying to get agreement amongst ourselves. You're never going to get this right 100%. And our trick is to try and get most of it right, try and predict. And it's a very unpredictable situation to an extent, okay? And I say to an extent because I think we're going to come to a door at some point, and it depends which way America wants to go. But I think the context, Michael, is this, that, as I said earlier in an answer, where America has got to didn't come about overnight. And a lot of it is self-inflicted, And I remember over the years giving presentations about the period after the GFC. Why is there no inflation? I said China is deflated in the world. China has become the de facto manufacturing base of the world. The Western world, including Australia, and particularly America, agreed to it. We did it with our eyes open. Did we understand the consequences? Well, the consequences are upon us as China becomes heading towards a $20 trillion economy and 20% of the world's GDP. And the way things are going, it will surpass America clearly in the next 10 or 15 years unless something happens. Then along comes Trump and denies all liability, but I think that's a little bit too cute. On behalf of the American people and the American corporate sector, he should accept responsibility. You can't just come in here and say it's all China's fault. They did what they had to do to sustain growth, get an industrial cycle going, bring people out of rural and poverty into lower middle class, grow their per capita income, and that suited the rest of the world. It suited the rest of the world. So today, it still suits
Australia. To be honest, it hasn't just happened in China. I mean, the reality is globalization's actually reduced poverty and increased health standards across the whole planet.
Correct. And when I hear today the American or Trump saying, we're being ripped off to the advantage of the rest of the world, well, with the greatest respect, the American economy is $32 trillion. I haven't seen it stop growing at any point, apart from the GFC, in this century. So that comment...
John, I think, though, there's two parts to that comment, right? I kind of think that the American government has underwritten the American corporate sector for the last 80 years. Because I think there's some truth to these comments. And that's why I opened with this point around broken clock twice a day. I'm not saying Trump's, a broken clock. I'm just simply saying you can be wrong about a lot of things and still right. And I think that what is right is the American government has underwritten defense for the entire world for 80 years, right? And that's come at a cost. And I would argue that the welfare states of Europe have been possible because they haven't made meaningful contributions to their own defense. And I think that's a completely justified position. I would add to that obviously American industry has massively benefited from that underwriting, but it seems to me that the American people and their government has basically given tremendous security and power to American corporations, which have then used that to generate tremendous wealth, which has also benefited the American consumer, right? But it's not wrong to say that America's debt position is terrible at a government level, and getting and structurally difficult to repair. When you look at what they've tried to do with these efficiency outcomes to cut all these programs, they sound abhorrent to get rid of these programs. How could you take food away from these people? But at the same time, if the government is going backwards at a rate of knots and unable to even cover the interest bill because the interest bill now exceeds their defence, you'd have to have some sympathy with people wanting to change that.
And Trump's coming from external, he's coming into the administration, if you know what I mean. If you create a problem, don't go back to the same people to fix the problem, who created the problem. So that's why you needed this intervention by an external.
And I think that's what the American people have done, right? The American, like you can sit there and go 25% of people voted for Trump, 75% didn't, but 50% sat on their ass, right? The reality is that anyone in America sees, and I was there in October last year, went across the country, you can see there's a problem, but none of them have known what to do to fix it. So I cut you off there for a sec, but what I'm interested from your perspective is, are tariffs going to work? Like, do you think his plan's actually going to? I think we could probably both agree there's a reason to do something, but is what he's doing going to deliver what he thinks it's going to do?
Look, I said earlier we're going to come to a door, two doors, and which door you pick is going to be interesting. And the two doors are this: does America substantially invest as a nation through tariff protection in manufacturing, i.e. replacing mainly Chinese-influenced imports? And I think the imports we're talking are probably 75% China influence, i.e. direct Chinese neighbours, Vietnam, Cambodia, for instance, Thailand, Malaysia, Mexico, and 25% of the problem is Europe, give or take. Australia's not even in the picture, except that we're in behind China. So does he replace the imports with a manufacturing base created? There is some sort of manufacturing base. We're not, as you said, the defence manufacturing base is being maintained. So there is manufacturing in America to some extent. A lot of the textile, white goods, electricals, a bit like Australia, being closed down. The capacity to manufacture things like iPhones, which you would have thought America would have had an advantage with the IP. No, they took to Asia and let them do it. So this is the door. Do we go full throttle behind a tariff wall, rebuild American manufacturing and replace imports? Or do they say, and this is the corporate sector, and there's a big conversation about to happen between the administration and the corporate sector of America. And I say in passing, I blame the corporate sector because they made a lot of money cleverly through technology, brilliant, very, very low capital models. So invest in technology development and get someone else to manufacture it. That's a clever business model which capitalism supports. That's the highest returning capital you can have. And that's what drove the American stock market. The other door is, do the corporates do what they should have done over the last 30 years and build manufacturing offshore? So you have offshore manufacturing owned by American corporates, so the profit returns to America and probably is taxed and contributes to the greater good of America. Or do they rebuild the manufacturing inside America? If they take over manufacturing offshore or build offshore manufacturing, does the administration give them, say, okay, because you own the factory, you own the logistics, that's tariff free because it's American owned? Now they're the two doors. I think the second one would work. I think the first one, where they replace it, has a lot of trouble. And that's the worry. I think if he goes hard on the manufacturing in America, you've got I don't know, 3, 5, 10 years, a lot of pain up front, and then yes, we get to an end result, assuming nothing else happens in the world. That's a big assumption the longer you go out. Whereas the other one, where he encourages capital to buy manufacturing and re-own it, take it away from the Chinese ownership and make it American ownership, that could be a negotiation. But we're dealing with an administration, as we say with Trump, who's got a vision. Hard to, I think I understand. I think you understand Michael's vision. I think he sees a problem. It has to be solved. And I'll admit I made a mistake. I remember saying to people, it wouldn't matter who is the American president in the next round, we'll have the same result. I was wrong. Trump has changed the rules, but I do maintain what we're dealing with today, Trump's brought forward. It would have been a problem at some point in the next 4 or 5 years.
Well, I think option two is actually a bit of the status quo, because if you look at, say, Indonesia, certainly Australia, most of Europe, most of the major companies are American owned. You know, the single biggest investor in agriculture, I think, in Australia is America, followed by Japan. So the beef conversation that came up this week is largely going to impact American investors that have bought Australian beef exports. And arguably, you'd say that there's a bit of a, let's say, come to Jesus moment for the corporate sector of America to say, well, there's a feeling that corporations over the last 80 years have been underwritten by America's defense and America's population to maximize the value of stocks. And that actually hasn't delivered the uplift in standards of living that were expected. Now, American standard of living has certainly gone up, but I think when you look at and a lot of the guys I've talked to over there, you look at 1930s New York and you compare that to any other capital city, and it was clear in the 1930s that America was 50 years ahead of the rest of the world. And now you look at New York and you compare that to the world's great cities, and it certainly feels like not just have these cities caught up, they're now 20, 30 years in front. And I think for a lot of Americans, there's a feeling that, you know, the corporate sector has done very well, but the government sector, therefore its ability to provide services, has done poorly. And this probably came from, the Democrats have talked about this and failed to execute on it. This idea that, you know, we're not taxing the rich, they'd say, but I think it's actually more just how corporates have made money and then kept it offshore.
Kept it offshore and not reinvested it. I mean, I think we've got to be realistic here. You know, like a lot of money has been made through technology and manufacturing and logistics. I mean, there's margin everywhere. The American corporate sector has really focused on the intellectual property, the IT development, and they whacked on the margin. And what do they do with that? They could have vertically integrated back and controlled the manufacturing back. They could have, they just decided not to. Which, from a capitalist point of view, say, why would I own my manufacturing? Because I've got 3 or 4 groups bidding on it. You know what I mean? I'll take the lowest cost provider who can provide the solution. And invariably, that was Chinese capital. That was Chinese capital. So that's where we ended up in one way or another.
And I think that made sense. And I think it's actually done a good service to the rest of the world, frankly, that it's lifted a lot of these people out of poverty. The interesting thing around manufacturing is, what does the next realm of manufacturing actually look like? Because, you know, I sort of think of it in 3 sort of epochs or eons. The first one was taking, you know, human labor and applying steam energy or, you know, electrical energy to it, right, to leverage. And then the second form was to automate that so that, you know, you've got robotics. And then I think the third version of that is where you have no supervision, no maintenance, no nothing, dark factories, which exist now in China, where there is just, you put the inputs in, you take the product out the end, there's no intervention. Now, when I look at that type of manufacturing, the next cost to cut is transport. Because if you've got a fully automated factory, you're not taking advantage of any labor advantage. All you're really looking at is the ability to create that factory, right? And I look at that type of dark factory as something you could put at the end of the street, right? And then it becomes how much volume is required. So we know, like, for example, casting steel, you've got to keep the equipment hot in order to cast steel. You've got to have a certain volume putting through it, right? A lot of mobile robotics that works in cold areas, you could have a run of one. You could make one item, then retool and make another one item, right? And so I see that innovation in manufacturing, even if it came back to the US, would not create any jobs. It would create new factories to cut transport costs down, bring costs down further on manufacturing, but it's not actually going to do much. And then you look at that and go, well, if I'm a global manufacturer, I'm only going to put 30% of my production capacity into an economy that buys 30% of my product. So if I'm Apple, for example, I'm not going to go, let's move all our manufacturing to America and produce from there and ship from America everywhere else. I'm going to put 30% of my production capacity in the US, and I'm going to put 70% of my production capacity wherever is closest to transport to the rest of the market. And I think that's the problem with this idea, because the way I've read it, and I sort of understand Trump to be a property and a debt guy, and that's sort of, I understand that because it's my place of comfort, if you like. And I can see what he's doing from a property and debt perspective. Says, well, anything I do to markets brings the interest cost down, which means I can borrow to build cheaper. And anything that brings tenants back in gives me more commercial tenants for my properties. So from a property debt perspective, tariffs work because, you know, well, what am I going to do? I'm going to force people to come back into my area, which means supply and demand is going to change. I'm going to have more tenants, yields will go up. the market goes down a bit, interest rates will go down. I know it's not that simple, but I can see why that mindset's been approached, the approach that's been taken here. And I think that the other thing I expect we'll probably see is huge tax cuts, because he's going to scare the crap out of the entire Congress with all of these tariffs. Everyone's going to be clamoring for some sort of solution, and the solution is going to be massive tax cuts.
The question is, I think you're right. They're flagging the tips and the working overtime and the mortgage cost deductions, and there's quite a comprehensive package, because he's got to, as he creates a cost of living problem through imports and tariffs, if he doesn't negotiate them away. So there is an incentive for him as well, because that's why he can't announce the tax cuts, so he knows what the cost impediment is going to be to his population, and then he'll try and balance it out with the tax cut. So he's got to, he doesn't want to jump too quickly on that one, but it will happen. I think you're absolutely right, and that'll probably be a reprieve for the American economy of some sort. Whether it benefits the budget, which is the underlying issue sitting behind this, let's not forget it's a $32 trillion debt. It's a $1.5 trillion at least deficit, and it's a $1.2 trillion trade deficit. These are massive numbers, and I think why he's come in so hard is because they weren't going to get any better anytime soon without a radical approach to it. Now, what he's trying to do is get everyone in the world to pay for it, which is interesting, because the American population can't pay for it. The American corporate sector can't pay for it. He's got to get the whole world to contribute. And that's why in his world, tariffs are a beautiful thing, because there's no other way to do it, unless he says he puts access charges on, which is what he may do, and say, look, forget about the tariffs, but if you want to import into the American market, the European government can give me $1 trillion and you can have open access.
I think he's doing a few things, because he's sitting there with NATO going, contribute your 2% or I'll pull out, and that is...
Which will save him.
Yeah, it's a mega saving on defence expenditure, which is, I think, $760 billion a year. Yeah. So if you can cut that by $200 billion, trying to rattle cages with Ukraine and Russia to force them to settle saves him a packet of cash as well.
Yeah.
Tariff saves a bit of cash if it works. The problem is always, do you actually lose more than you gain when you put them on?
Yeah.
And then Doge obviously trying to cut, whether they've been successful or not, it's another thing. But, all these cuts they've tried to make on their social services to try and, get that budget down. So
and the interest bill, because he's stirred up the American financial system into the risk of recession. And what happens? The bond yields come down. They've gone below 4% today. The yield curve is flat. He can borrow now at 4%. 6 months ago, he was looking at 4.5%. Before that, 5%. So if he can drive that bond yield down to 3.5%, so from 3% cash rate to 3.5%, when you roll your $30 trillion of debt and you can save 100 to 150 basis points, you're talking $300 to $500 billion in interest. Now, you haven't saved it because you haven't spent it yet, but you saved it on the roll.
Yeah.
And that was, I kept on saying to clients in presentations, look at this interest bill. Look what America's paying for its debt. The average, if you look at the budget, was 2%. If they rolled the whole 30 trillion at 4%, there's 600 billion coming down the right, and he's trying to avert that. So there's reason for this madness, and that's what we've got to acknowledge when we look at this situation.
And it's funny, isn't it? Because it's sort of, you can see the Democrats not doing anything, because half of them would have to be sitting there going, well, he's going to make all these hard choices we don't have to make, and then we'll be able to benefit from it later. Because you do absolutely want to try and lock in debt lower. You do absolutely want to make cuts that no one's going to find popular, and then you can come back with a balance sheet that's got more money again and find new ways to spend it.
Yeah. That's it. And he hasn't got 4 years. He's got a midterm election next year, so he has to move quickly and aggressively and get the flattening out of the way in 2025 with a recovery of some sort in 26. Now, my only point is, and this is, no one knows, if you go the manufacturing route, you're not going to get the recovery in 2026. There's just too much to do. If you go take over the import manufacturing offshore, you probably do get a quicker recovery. So that's why we're going to come to the door, and it's going to become obvious. The other thing, and I think this is worth noting, if you listen to what Trump, and he's giving interviews regularly, which you've got to take your hat off to him. There is no hidden agenda here. He's open. Now, maybe the people questioning him are biased, so let's not get too carried away. So I think he sort of restricts who ask questions, but he does talk. He claims that 50 countries have approached him over the weekend to try and negotiate their tariffs. Well, I would say that'd be exaggerated, but let's just play it for what it is. But the one country who didn't negotiate was China. And I think the China response aggressive and quick was probably, I think the American administration said it's possible but unlikely. I think they would have been taken aback by what China's done and said, well, if you want to play that game, let's have it out now. And you know the situation. I think people should realise the American trade is about 5 trillion. They import and they export about 3.8 trillion. The deficit directly with China is 250 to 300 billion. The indirect deficit with China, Trump said on the news alert today, he thinks it's $1 trillion. Well, I think it's an exaggeration, but let's call it $500 billion to 600 billion. Put on what is the tariff now, Michael? Is it 54%, 34%? Crikey. But we are talking massive tariff collections. But where the argument from Treasury, and I've listened to the Treasury head and Trump, they think it's going to be paid for a combination of China, an increasing US dollar, and American citizens who'll get an offset through lower petrol prices and tax relief. Yeah. So it'll all work out. Maybe it does. Is that a Goldilocks scenario? Or is that I don't know. But that's what they're arguing. So we're sitting here. If that came off, crikey, you'd say, well, that was a big hiccup about nothing. But I think we have had a dent in the American stock market. I think we've got to be realistic. And I'll just make this point. I know we're throwing a lot at the listeners, but the American stock market has corrected. The bulk of the correction has been in the Magnificent Seven.
Yeah.
You take the Magnificent Seven out, and about 70% of the fall is done away with, about 7 or 8 stocks. So the broader market, yes, it's fallen, but not as much as you think. It's really the stocks which charged up over the last 2 years to ridiculous values in some instances, which are coming back to earth. And that's why you've got to reflect on Australia. Why is the Australian share market really panicking? It's not about specific Australian issues. It's really about China. And I just question, do we have a strategy with China? What is Australia's big picture plan with China? Are we friend or foe? We made that decision on the weekend regarding the Darwin terminal. I don't know where that came from. We gave them a 99-year lease. Now we want to take it off them. That's fine, but why do you do it in the middle of a trade war? As your stock market's going down 10%. That's akin to blaming China for the COVID disease, where they slammed us with, as you know, embargoes.
Yeah.
What are we trying to do here? So I think we struggle. This goes right back to one of your early comments about direction of Australia and investment. You'd have to say Australia's leadership, we're rudderless at present. And the opportunity which I talk about, and I don't you agree with, but it needs direction. And America, whether we like it or not, has some sort of direction under Trump. You might not like it, you might not agree with it, that's fine. But what's our direction?
Yeah, and I reflect because I've done a lot of business in China and Hong Kong and had an office there for a while. And the reality is that China took the GFC and threw billions of dollars into its own economy. So what they've been looking at for the longest time was how do they achieve agricultural independence? They know full well that they import a lot of produce, but they've been looking at ways to build out huge aqua farms so that they don't need to take anything out of the ocean, right? They've been looking at ways that they can grow food in, controlled farm environments. So they don't have to import any food. Everything China's been focused on with massive infrastructure investment and capital spending has been focused on independence. And so I think half the reason they've sort of gone to the US and said, I don't really care about your tariffs is because they've been looking for the last 20 years as to ways they can make sure they are independent. I think they've known for the longest time that they got the gift of this massive, manufacturing investment and all of these, as they modernize their economy. But they took all of those opportunities and they turned them into something that can sustain themselves. Now, they and Korea and Japan and Russia and to a certain extent America, but less so, have this massive demographic issue as well, where their population's going to age out quicker than they can replace children. And, they built all these massive cities and they could end up being empty, pretty soon, actually, because the rate at which populations decline when you have replacement rates below 2 is quite dramatic. So I think it's really interesting. And when I think so we get back to Australia, so we sort of think about America and we think about China and we think about where we are, the vast majority of our exports with the Chinese market. And you could argue that, that's China then exporting across the US, but it's actually not. The Belt and Road Program, all these other works have been about feeding their own population, energy independence, agricultural independence, and then creating soft power relationships with all of the rest of Southeast Asia. And what I get excited about, and we could bring it back home to Australia, I think despite our challenges with leadership, despite our lack of engagement, I would say, is a big cause of lack of leadership in politics. And despite our, defense connections with the US, the reality is we are just so perfectly placed in Asia. We have a strong economy, we have all the resources, we have all the agriculture, we have all of the knowledge, we have science, we have really productive population, and we're sitting in amongst this group that is going to continue to be the fastest growing economies for the next 20 years. I mean, I look at Indonesia, our closest neighbor, and just think the opportunity there for Australian companies is immense. Now, American companies, petrochemical companies and others have been there for a long time. But for us, very close trading partner, what is it now? I think it's 300 million people that'll be moving. It's about the same size as US, I think, modernizing their economy. And every time a major economy has modernized, it's taken about 20, 25 years. Japan took 25 years. Even when you go back many years ago, London took 25 years to modernize through the steam age, effectively, to become a more prosperous economy. And Indonesia is going to do that right now on our doorstep. They're relocating their entire capital city. So you look at Indonesia, you look at Vietnam, you look at all of these countries, you could say, yes, they're dependent on trade with the US. But what's also happening is their entire populations are shifting out of poverty. They're getting used to buying, better quality clothes, better quality food, and we're just so well positioned to take advantage of that. So when I look at all the stuff that's happening in the US, I just think we've got massive underinvestments in infrastructure, which we can address. We've got huge areas of land and productive land for population or for food or for energy production, but we're hamstrung by incredibly inefficient energy infrastructure, huge costs for power and electricity, and a lack of ability to take our government balance sheet and deploy capital in our own currency and our own economy.
And an archaic tax system, which, Trump is going to adjust taxes in America. It'll be interesting to see what he does for the corporate sector, but he's talking about American companies who commit to invest capital in America to give them instant write-offs, which is something we do in Australia. He's also singled out some of the European countries which are export hubs, like Ireland. Ireland didn't build an export hub by not having significant tax advantages for multinationals to position there. Now, all these things are proven, and Australia's sat back and never, as you say, all the advantages you talk about, we've never played to our advantages. And that's just bad management. We elect a government, we put people in Parliament, and their job is to manage Australia for the benefit of Australia. And we seem to always have a look over our shoulder about what America wants us to do, And I think you've seen the repercussions now. You would have thought, I've been in markets, I think as you described, 40-odd years. And it was always, I remember way back in the early 80s, the first thing in the morning meeting we used to talk about was what happened overnight in America and what's the Fed saying. Now, you would have thought 40 years later, we might have moved on a bit. But our whole focus in Australia's capital markets is what's happening in America, despite the fact our biggest trading partner is China. We don't wake up in the morning and go, what's China said overnight? What's China doing? No, what's the latest utterance from America? And that shows you we haven't matured as a capital market, which is interesting. $4 trillion and we haven't got a mature capital market. Quite bizarre. And the opportunity is immense. Everything you talk about is fundable. We can finance anything. And we think billions of dollars is a lot of money. America's got $32 trillion of debt. And are they phased by it? They've got a problem. They're going to fix it. If we're wetting ourselves because we think we've got $1 trillion of government debt. We haven't, but we will soon. Net we won't. And we're worried about it. Crikey, we've got 4 times that much in super. The rest of the world must look at us and go, what are you guys doing down there? You're in the perfect position. You've got so much money. You're one of the best places in the world to live in. Everyone wants to come here to visit. We love being educated in Australia. Anyway, we're sitting down here, and you look at the moribund debate going on in the current election cycle. It's appalling. And I don't know what's going on today, but I haven't heard any news release that either of the potential prime ministers is talking about, the geopolitical issues emanating out of America and what they think they should do about it in terms of a long-term policy. Nothing. Or they're going around the country giving out handouts to buy votes,
Yeah.
So that's the problem, And we sit here should we be worried about America? We should be concerned, okay?
Mm.
Not for the reasons you think. We're concerned because we reflect American stock markets and American capital markets. We reflect them. We don't think independently. And if you don't think independently, you're caught. So we all wake up this morning and the futures are down 5 or 4%. The stock market went down 6%. And God knows what it's doing now, 3 or 4% down. But tell me, we all decided that the market is going to be down 4 or 5%. Why did we all decide that? You know, serious? Yet we've got trillions of dollars to invest back in Australia. We've got hundreds of billions of dollars sitting in offshore markets. And why doesn't that money come back? The currency's just dropped 10%. Logically, if you get a 10% devaluation and your money's offshore, you'd be thinking about bringing it back.
Yeah.
And if you can buy Australian bonds for the higher yield than American bonds, and you haven't not taking currency risk, and you've just had a free kick in the currency, that would stimulate. But nothing's happening. Nothing happens in the land of Oz. You know, we've got default fund managers. It goes right back to what you said. You said. The opportunity is large, but no one's directing the traffic. The lights are going off and on, but it's like time to walk, and we don't walk. We wait till it goes, don't walk. We stop. We don't walk. We stop at the stop sign and don't move. You know, we're not proactive, and that's what's causing the disconnection in the Australian stock market, I think, because we don't have direction.
I agree. And I think where the tail wags the dog. America is actually a long way away from us and 5% of our export market, and yet it's global news. I mean, it's Australia-wide news. I look at it and go, we've got fantastic trading partners right next to us. Why aren't we jumping in with them? Why aren't we setting up arrangements? Like, my personal view is 10% tariff on Australia just means every other neighbor we have is going to want to look for ways to trade.
Absolutely.
And be on the phone to every one of the guys close to us saying, how do we buy more of your produce? How do we export more of ours?
Yeah, well, the currency was 63 cents when they put the 10% tariff on, and the currency is now 59. So most of that tariff doesn't mean a thing. The currency's just dropped. So that 10% is being offset. So they'll pay the same price for our beef, but they'll get 10% going to the American government. They'll call it a tariff. It's really, as you said on the weekend, it's a GST. It's a consumption tax for Americans. I mean, so our total focus is the sentiment in America and what China's going to do. And I think my final point, I know we've got to finish up here, the American administration clearly expects the Chinese administration to pay the American government something to keep the trade going. There's no evidence to suggest that's going to occur at this point in time. That would take a high-level meeting between the two leaders. So that's not being offered at present. It's more likely at this stage that China says, no, if you put pressure on our manufacturing, if you put pressure on our friends in Cambodia and Vietnam and Thailand and Malaysia, we will bail them out because we've made a long-term commitment. And in time, those manufacturers will be supplying not only the local Chinese market, but supplying European markets and other Asian markets and other BRICS markets. Okay? It's a long game for them. And they've got the capital resources. And Trump's, with the best will in the world, has about 12 months. China probably has capital to go for a decade. So he has an advantage by being a bigger market, but he has a serious, and he thinks, it's interesting, and my final point, he thinks the advantage lies with the country who has the trade deficit, which is this bizarre one, and he also thinks from his, and you'll get this as a property guy, because he's got so much debt owing, that he thinks, oh, well, no one's going to put me under. You know, the more debt I have, you know, you own the bank if you owe the bank more than what their value is. He thinks that it's an advantage which he's going to turn on them. He has a little bit of advantage because I think China has $800 billion US at this stage of American government debt, and there is a fear that he might renege on that, which is a very big. I don't think it's going to happen, but that sits out there as a risk. And you notice Russia bailed out of its bonds a long time ago in America. He seems to think that China will come to the table and pay for the privilege to import into America. I think it's going to become pretty obvious pretty quickly they won't. And so then we go into plan B. Is there a plan B? That's the question. And that's where Australia gets caught. What's our plan? I think it's obvious.
I think the Chinese will give them something because they'll have their plan B, but they'll still look for a way to maintain trade. I think ultimately the Chinese government will come to something. It just won't be what Trump wants, but he'll take anything as a win because he achieved something that he didn't have before. And I think that I always bring it back home and say, what should we be doing in Australia? And I think what we should be doing in Australia is I think it's a reminder, exactly the same way the Chinese tariffs were, that we should be a friend to everyone. We've got all the resources, all the opportunity, low debt per comparison. We should be investing in infrastructure, creating opportunities that allow us to deliver more and be a friend to everyone, but able to defend ourselves at home. And I just think we should look at our relationship with China and go, they're a great friend, they're a great customer, they're a great group to work with. We need to better defend our own country. We should look at America and go, they're a great friend, they're a reliable, have been a reliable partner in the past, but we should also still be looking at the way we defend ourselves. I personally think that the fact that we've got oil reserves held in the US when there's a huge ocean in between is madness. I think that we should definitely be looking to buy equipment and trade knowledge and IP with America and Canada and the US, and the UK and Europe. But we need to be able to stand on our own 2 feet a bit more. And I personally think that the biggest weakness we have as a country is our energy generation. Like the cost of power in this country is the main reason we don't have any manufacturing capability and can't turn our science and our IP into productive capacity is energy costs. And I don't know that we've done enough to address that. It's probably a conversation for another day, but I just think that's our weakness. But if you're Albanese or you're Dutton, you should be on the phone to half of Asia because they like us. I mean, I've traveled across all of Asia. They love Australians. We're great people. We're easy to deal with. We do what we say we're going to do. We're great business partners. And we should just be looking to do as much business across Asia as we can because demographically and geopolitically and macroeconomically, Southeast Asia has miles to grow, irrespective of what America does.
Well, we know the numbers per capita. There's 3.5 billion people in Asia and there's 330 million in America. So there's 10 times the population. If the per capita income of the Asian region is 10% of America, they're equal. They're equal. Yeah. And what do you think the opportunity is to grow America's per capita income or Asia's per capita income? It's obviously Asia's per capita income, and small numbers will multiply into big numbers and big opportunity for Australia. So the potential is enormous. How we position in that is the interesting discussion, the interesting thought process. So everything has a reaction. And bad news from America, a kick in the pants for the world, is a kick in the pants for Australia. Our lackadaisical approach to international geopolitical issues, international trade, not focused on our own comparative advantage, getting our costs down. This is the kick we needed. I'm just sitting here looking at our leaders. I don't think they've been kicked hard enough to realise there's an opportunity. They need to have their heads banged together, is what I'm saying. But look, I think it's a great conversation. I think from our clients' perspective, we're thinking about it. We're open for business. We're open to dialogue. Questions, please send them through. If you don't think we covered this issue good enough, if there's more questions, please send them through. We're happy to do this regularly. And we're going to be in the offices of Sydney and Melbourne and Adelaide regularly, and Brisbane. Happy to talk to you.
Yeah, absolutely. That's a great chat, John. Thank you very much for your time, and thanks everyone for listening. And we'll dial in again next time.
Thanks.